Hi, everybody. This is David Skrika. So this is going to be more of a presentation than a stock chart of the day. Um, so, um, but it's still kind of like a combo of both. So, because we're going to talk about debt, and I got some good charts that I've retweeted and also just in general. So the one thing that has scared me when I've talked relatively bullish here in the last little while, and we've had a couple of these small companies, especially I'm not going to mention here because this is on my free list, but do well. And um so basically, but basically, one thing that really worries me right now, I've always in the back of my mind been worried about a sovereign debt crisis. Now, what got me interested, one of the books that got me interested in markets, and I think it was, he published in 1992. So at that point, when I was 14 years old, but I think I read it when I was 15 or 16, 93, 94, and it was bankruptcy in 1995. And Harry Figge talks about, like, all this government debt that had been racked up into the early 90s. Remember, there was a bit of an increase in deficits too because of the recession of the early 90s and how the government was going to go bankrupt. And he had these kind of like hockey stick graphs where the government debt was going straight up, which is exactly what has happened. But the thing is that because of what he failed to realize, and I'd never thought at the time, being a teenager and being new to financial markets and economics, hey, even into my 20s and 30s, I didn't realize the extent they would go to suppress interest rates, quantitative easing, ZERP, all these things to kick the can. And actually, if you look at Figge's long-term projections of debt in this book, the debt has gone up faster than he projected, over 20, 30-year period. But again, having that long-term, first of all, he failed to grasp the long-term interest rate cycles. So interest rate cycles are very long-term, 30, 40 years in length, and we had a bull market in bonds and declining interest rates from the early 80s to the early 2020s. So he failed to recognize that long-term cycle. And then also, again, who would have thought all the trillions in printed money, et cetera, that would have happened, So that's kind of what Figge failed, to recognize or realize what would happen. So, what can you do? I think a lot of us failed to see the extent that they would go to suppress rates or the whatnot. So, another book was The Great Reckoning by James Davidson. And it was the same kind of thing, decline of the welfare state. You can see published in 93. So this is all what got me interested in economics. I was always a stat nerd, and when it came to sports and the whatnot, football, hockey, baseball, even basketball. I loved stats, especially people know I'm a football nut. So, loved, looking at yards, receptions, touchdown passes, completion percentage, all that kind of stuff. So then, of course, that's helped drive my interest in markets economics because there's a lot of numbers involved. So but these were the kind of the books I got interested to, were kind of these doom and gloom books. And I think a long term they're all right. It's just that, shorter term, they just fail to recognize increases in productivity due to technology. And this is all these books are written right on the cusp of the internet, of course, being introduced and expanding. And then, of course, all this quantitative easing and cheap money and stuff. But I think the basic thesis is correct in all these, where it's like, basically governments are spending too much money. The government debt is too high, et cetera, et cetera. So anyway, I just wanted to show you that's how I first got. So this was always in the back of my mind that, obviously the debt crisis was in mortgages in 2008 and private debt, but like always in the back of my mind is what happens is, like, in 2008 the government's bailed out the banking sector. What happens if the government's the one that goes bankrupt? And this hasn't been anything to worry about because, again, of that long-term downward spiral in interest rates. But here's the problem. Now we'll go to the TLT, and you can see the TLT, which is the 20-year plus treasury bond in the United States, is down again here today after the rebound on Friday. You can see what it's done basically year to date. TLT started the year around 101, is 96. If we look at the 5-year chart, you can see that it's at lows and has been rolling over, which of course means that we're going to look at the TLT longer term here. You can see if we break that 2022 low, we're at the lowest level since 2014. And let's get a really long chart, and then we'll look at the TNX, the actual 10-year yield. And you can see probably the next area of support would be the 2013 lows, which is 80, which would be quite a bit higher than here in yields. And then we got about 60, which is roughly this 2008, 2009 low after the spike during the financial 2009 2010 low, after the spike, in bonds and a flight to quality. And it does look like, if you look at that gap up here, reversal, this looks like a kind of ultimate blow off of kind of the secular bull market of bonds. I'm taking off the log scale so you can really see it here. And then we had our bear market rally in 2021. And now it looks like, is this just another bear market rally? You look at here in 2016, 2018, we kind of had a double bottom. It took a couple of years. Is this going to be another double bottom? I don't know. Like, the thing about these bonds, we're going to show you the bond yields longer term, is that the cycle is so long. We're going to actually go back to the 1980 to show you the yield. And we're going to go back. Yeah. So you can see here, 16%, but look at there are spikes in 84, 85, spikes in 87, 88, spikes. This is that when those kind of books got popular, because it looked like another spike in yield was happening. And it just ended up being, a short-term blip in the long-term downtrend for interest rates, bull market for bonds. So you can see here, there were these spikes. So I think at some point, I don't know if it'll be from 5-6% or from here, there will be a decline in yields. And it's like, you can turn this chart upside down, and that's what we're going to see probably the next 30 or 40 years, but it takes a while to get going. You just don't spike to 12% right away. We were at under 1% on the 10-year bond. So where you can see it even more so is, the short-term interest rates, where, you can see this downward trend again for the 40-year period. And now we've broken that. And actually, not only have we broken the last high, but we've broken the high, or we're right at, actually, we have broken the high. And now we're the highest since 2000. So I would think that the 2000 high would probably be the next resistance here. And again, I would think that this is going to have like 3 steps up, 1 step back kind of thing as it moves higher. So if we peak here around 5.5%, 6%, whatever it is, we probably go to 3. See, at 3, everyone's going to think like, see, remember back here in 80, 85 or in 87, people are like, oh, or even talked about 94, when those books got popular. People are like, oh my God, rates are going to go back to where they were in 1980, because it was still in everyone's memory. Well, now everyone's memory is low rates, and now everyone's hoping for this. And look how long we had the zero rates, other than, a little short-term period here from 2017 to end of 2018 for 2 years. We've basically had zero rates from most of 2009 to 2013. And 13 years is not long in the history of the world, history of financial markets, but in someone's life, it is. Like, the average person lives to 80 years old, and your average adult life, say when you turn 20, you could say, or 18 is 60 years, that's 20% of somebody's average adult life, right? So yeah, so that's a long period of time, and people think that's going to last. And then if you also take into account that rates went to zero for 3-4 years here since from 2001 to 2005, that's 4 years. Like, really the last 20 plus years, other than 2005 and 2006 and 2017, 2018, really, and then the last year and a half, you spent about 14 to 15 of those 21, 22 years at near zero rates. So this is what people are kind of used to now. So they're going to think, oh, rates are going to go right back to zero. But I think what's going to happen is, rates might go back to 3% or something on the short end. And when they cut in the next, downward cycle in rate, but then you're going to have higher highs and higher lows in interest rates, just like you had lower highs and lower lows for years. So why is this important? Well, the problem is we're going to look on my Twitter feed here. I retweeted a bunch of stuff. I was looking for a corporate bond chart, which unfortunately Danielle got rid of. First, I highly recommend Danielle DiMartino Booth's Twitter account. You can get mine too, Addicted to Profits, David Skriga. My account is locked. It's really just for people I know, etc. But if you do request and just write me an email, addictedtoprofits@hotmail.com, tell me your request, I'll accept you. I had a guy trolling me on the internet. That's part of the reason I did it. And I just didn't want to put up with it. So anyhow, we can see here the interest payments and surging, and you can see that as recently as 2018, 2019, interest payments are only just over 400 billion, and now they're closing in on $1 trillion. So that's what's happened here. And Jeff Gundlach, and if we go look at his Twitter, he has stated recently yeah, I don't know why they didn't put that up, considering, see, this is what Twitter does, because he's not whatever, he's not that blue check mark thing. So anyhow, he stated recently, blah, 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 and the short-term debt issued to zero a few years back is coming due. So what he's talking about is like all that debt, like they were very short-sighted when they did all that debt in 2020, 2021, over COVID. They only did like bonds that were mostly short-term orientated, and they're all got to be rolled over. And one thing that Gundlach stated as well is that, the interest payments we just saw has gone to $1 trillion, that if interest rates stay there long enough and all this debt is rolled over, over the next 3, 4, 5 years, say interest rates stay to 5.5 over that 3 or 4, 5 years. Here it is, 1 trillion per annum, 3%, blah, blah, blah. No, actually, sorry, it's another one. Anyhow, but if that is rolled over, that 1 trillion in debt, that debt will become 2 trillion. So he's not right about everything. He said the Fed will not raise interest rates again. They did. So he's not perfect, but the issue is now we're getting like a quarter here, a quarter there doesn't really mean much right now. But the long-term problem is, as rates stay higher, this is where the Fed is in a catch-22, right? Is that as rates stay higher, the interest payments on the debt are going to go higher, right? And it's already projected now the debt will be 50 trillion by 2050. Oh, sorry, by 2033, 10 years, right? Go from 30 to 50. So interest payments will go higher. But if they start cutting rates, we're not out of this inflation cycle yet, and inflation will spike again, which means rates ultimately will have to go higher again. I think they're going to just end up cutting rates because that's the easy way out of this sort of thing. So, so we can see that's problem with, and then, the government spends all this money, Social Security, defense, pensions, etc. So if this interest payment keeps going higher and higher and higher, that affects their ability to spend on all these things that you take for granted that the government does. And also means that the government can't do stimulus and that sort of thing, and hurts the economy as well, or it hurts the growth rates of the economy. And then it filters over. Like, not only has there been a government debt boom, right? And there has been, a corporate debt boom. And you can see that, corporate debt was like $85 billion in 1952, and now it's north of $12 trillion, right? So, has the economy grown that so much in 1952? It hasn't. And you can see it really blew up. I showed you that long period of almost zero rates going back, to 2009. Well, we can see these zero rates here. That's, notice that government debt went from 6 trillion to over 12 trillion, double in just that 10-year period. And that's the reason why, right? And it's continued to go higher. Now, I think you're going to see a slowdown now with these higher rates. And the issue is, and I talked about this with the McDonald's example, a month or two ago, was that as these companies have to roll over that debt, because they really can't just pay it off. A lot of the companies, just like the government can pay off that 33 trillion tomorrow, have to roll it over. Well, all of a sudden, instead of that debt being rolled over, which we're going to show you right now, so you can see that was a downward in interest rates. Instead of that debt being rolled over, this is the AAA corporate bond yield. So at 3%, a lot of the big corporations who are really have, good credit, we're even able to raise rates even lower. At that, you can see that it went down to 2% in 2020. So rather that 2-3%, right now we're up to almost 5% on the bond. So they're going to have to pay higher interest on that rollover, which means less money for buybacks, less money for investment, et cetera, et cetera. And what we can see here is that this AAA corporate bond yield historically is roughly probably been in the 5 to 7.5%. We spent the last, 13, 14 years below it. We spent the 30s, 40s, and 50s below it. And then we spent, most of the, a lot of the 60s, 70s, 80s, and 90s above it. So I would say roughly that 6%, 7% range is the average. Now you could say, Dave, well, we spent 30 years below it from, the low, early 30s to, mid 60s. Why can't we spend another 30 years below it, really starting back here in 2010? Well, my argument would be there was so little corporate debt back in the 40s, 50s, and 60s. You could spend all those years below it because there really wasn't much outstanding. Of course, that was also the peak of America, World War II becoming the industrial and military power. And then, the 50s and 60s, US was really at the height of its power. So I would say now we have so much debt, again, look how much debt was back there in the 50s and 60s, right? And now we've got so much corporate debt and, compared to now. So we got too much debt. Inflation's coming back. Look what happened when inflation began to come back in the late 60s, even with not that much corporate debt outstanding, these yields spike. So this is the danger again. And this is what keeps me, I don't want to say up at night, but this is what worries me about derailing the rally, because so much of the rally is dependent on this cheap money. It's not just the government funding itself, but this cheap money filters down to corporations, and they use this money to expand operations. To, if they're like a company that has a lot of bricks and mortar, like a McDonald's, like a restaurant chain, they can use cheap money to, rebuild. I notice, like when I'm here in Canada and the States, because we don't really have chains in Eleuthera, but like the McDonald's, Tim Hortons, whatever the chains are, they look really nice. Like I was in an old Wendy's that I used to go to as a kid and was kind of dumpy back in the 80s, when I was a kid in 90s. Well, now I go in there and it's like, wow, this is really fancy. This is almost like a real restaurant, And so, and a lot of that has been cheap money. Wendy's, McDonald's, Tim Hortons can all borrow and then, revamp, their locations. So that's all a problem. So that all filters to everything. And then, of course, if there's too much interest expenditure in, corporations' balance sheet, that hits their profits and the share price declines as well. And then of course, at some point, banks don't lend money, all that sort of thing. So, this just also just shows, this is some more things on the amount of corporate debt outstanding. I showed you that chart, but this also shows it, this article, and we can see the leveraged corporate debt. So this also affects junk bonds as well. I'm showing you investment grade. And by the way, that's another problem with this whole thing with corporate debt, was that this huge amount of increase that's happened. If rates were to normalize, the amount of interest payments that corporations now have on their balance sheets, because their corporate debt is so much higher, something like 2/3 or 3/4 of corporations that are rated investment grade are basically junk, because their only way that they can sustain the debt that they have is due to the low interest rates that existed, that now no longer exist. So, and you can see this is leverage debt. So this is bank loans, second year loans, and of course, a big one is high yield bonds. You can see that's gone from the financial crisis to about 1.3 trillion roughly to over 3 trillion. So, and by the way, this would be really interesting if we have higher interest rates, even if oil prices go higher in an inflationary spiral, because what would happen, what would happen in the inflationary spiral is, banks loaning money was a big reason for the fracking boom. Well, they probably wouldn't be able to do that with higher rates, because it was the perfect scenario where you had higher oil prices roughly from most of 2007 to 2014 and to a cheap money. So it created a perfect scenario for the boom in that. So, and you can see this is who owns it. Non-US investors, you can see, have really increased their amount that they own. You can see insurance companies, they're the ones who could really get hit Now, granted, on one hand, insurance companies would be getting more interest off these loans, but the problem is, I think 90% of investment grade corporate bonds now trade at a discount to, their par value. And the reason is because they issued so much debt cheaper, and there's no way, they're worth what they were when debt was cheaper, right? Because debt is now more expensive. So that's who owns it. But again, I just want to see how that government debt trickles down. So then the second part of this kind of debt bubble is Japan. So Japan is and we're going to show Japan and just other sovereign conference, but Japan is the big one. So we're going to show the Japanese 10-year treasury. So Japan has been able to cap its rates for years. Japan has a debt of 260% of GDP. And over the last, 15 or 20 years, I don't even think this chart goes back 15 years. Yeah, it goes back. That's long enough for what we have to do. It does go back 15. But you can see Japan, right after the financial crisis or during the financial crisis, went to almost 2% and went down to negative rates actually, and spent most of, 2016 to, 2022 under, 0.25%. So they had actually a limit where they would buy bonds and they would not allow the 10-year bond go above 0.25%. But because of the debt load and mostly because of actually increasing inflation, Japan had to let that go. Then they hit 50 basis points, and now they've upped it to 1. Well, you can see at 64 basis points, Japan now has the highest interest burden since, 2014, when the debt was much lower. And if they were to go to 1%, it would basically be the highest since, 2011. Again, when the debt load was much lower. Now, this is important because if we look at countries, Japan, you can see, is the most indebted country in the world at 260% of GDP. Even the government net debt is almost 170%, which is the highest in the world. So they can only afford so much interest. Where the US, I think, breaking point would be 5 or 6%. I think Japan's breaking point would be 1.5 or 2% because of this huge debt load. Maybe they could go to 2, but definitely 2.5 would be the breaking point, for Japan because of that huge debt load. Now, some of this debt is owned by the central bank, which means the interest would just go right to the central bank and then right back to the treasury. So that's maybe gave them a little more leeway. But then on the other hand, the flip side is Japan, the central bank owns these bonds and then would accumulate huge losses on them, if rates were to go to 3-4%. So again, then the higher rates, and again, Japan, let's say that would happen. Then Japanese corporations, the borrowing would be more expensive. Their currency would probably go down. Japan has to, of course, we all know it has a huge auto sector. It has to import all the raw materials. That gets more expensive, which means cars globally get more expensive. So it has all these trickle down effects. So, and we can see here, that would be the problem. So of course, Japan going down, being one of the largest economies in the world, would have a huge effect. We saw when little things like, the Asian currency crisis back in 97 or Russia in 98, when we get these, like subprime mortgages are pretty small as a percentage of the global economy. You can see when we get these little crises, the effect they can have globally. So imagine one of the largest economies in the world having a debt crisis, what that would do to the global economy. And then we can see Italy is at 144%. Italy is one of the larger economies in the world. And then as we go down, Portugal, Spain, France, Canada. Canada's really at US levels because this is just federal debt. If you include the provincial debt in US, it's about the 134, 120, 130%, right? So, and Canada has much more in terms of private debt because of the housing bubble here as well. So you can see these are all quite large economies. Even a lot of the emerging markets, which had low debt for a year, Brazil, there's where I live in the Bahamas, because Bahamas is tiny though. They've taken on a lot of debt since, the start of the financial crisis. It used to be like anything over 70 or 80% of GDP used to be seen as a huge amount. Like India, for example, India was at 40 or 50% for years. But again, financial crisis and then all the spending governments did after COVID has even made India quite indebted. The advantage India has is India's growing fast. India is growing at 6% a year. So that means even if they run government deficits at 4 or 5% a year, the debt as a percentage of GDP is shrinking. So that's the advantage that India has. The problem with all these Western countries, I showed you, Italy, Spain, Portugal, United States, Canada, they're not really growing fast. And if you continue to grow your deficit at 2 or 3 or 4% a year, and you're only growing at 1 to 2% a year, of course, your net debt grows. So again, and so much of these countries' economies now, spending, etc., is part of the government. If the government is part of the economy, that's what really, really worries me. So that's what I would think could derail this great market rally we see, not just since the bottom in October of last year, but really since the financial crisis bottom, is that if you get some kind of sovereign debt crisis, and if it were to occur in a massive economy like Japan, like the US, it trickles down to corporations, and then you get some kind of really massive, deep recession. Now, will that happen? I don't know. But I think this is always your caveat. So again, the trade I have always for this is the investment grade bond ETF, long-term puts, which you can just roll over every, say, 6 months or so. And the reason being is you can see the yield is 3.74%. That I think the ETF could go down even more. Obviously, if rates went to 6%, it would mean that this fund can go down 30-40%. And then also remember, a lot of those bonds, which are investment grade that they own, would probably be downgraded to junk, which means they'd have to sell it. And bonds on the open market do not have the liquidity that equities have, which means they'll be selling into the market and there'll be no bidders, basically. And a lot of those bonds will probably start gapping down 20, 30, 40%. That's the doomsday kind of scenario. I don't know if that will happen. I think ultimately the Fed would be probably forced to buy bonds, but still there would be a disruption before that occurred. So another reason I like these is that, let's go look at the January 2024s. Look at the implied volatility. Well, those are the calls, but like on the puts, no, these are the puts, sorry. Yeah, you can see like virtually nothing. No, for some reason it didn't. Yeah, these are the Januaries. Well, those, you can see like you're talking like the 101, the 100s trade at $1. The 105s trade at 268. There's virtually no implied volatility in these bonds. So that means if you get a blowout, let's say these were to go to 70, not only would the price blow out, like if he goes to 70, the 105s would be trading at 30. Your volatility is going to blow out. Probably the volatility would double at least. So probably at 70, those $30 bonds would be trading at 50, 60, especially in a panic. So and you don't need a huge decline. You don't need a 80% decline. You just need a 20 or 30% decline in that. So that's the trade I would use to hedge against this doomsday scenario. But what I really wanted to show you here is those higher rates really worry me. And of course, we got Japan losing control of their bond market, upping their upper limit on rates to 1%. We got the US being downgraded by Fitch, and that has hit the bond market recently. And again, I don't know if this will continue. The one advantage the US has right now on its side is, inflation is coming down. Inflation will probably continue to stabilize for the next 6 to 12 months. So that could stabilize yields. The economy looks like it's slowing. So that could also help yields because, that may trigger more disinflation short term. But, of course, if you were to get something like, if we look at oil prices, I'm going to talk about that tomorrow, Tuesday, they're close to breaking out, et cetera, et cetera. So if we were to get all of this sort of thing, happening, and then inflation reaccelerates, then I think, everything can be off the table. But I just wanted to show you that. I think that's the risk. I always get worried when something like this, when rates start to spike. That's what happened in 1987. Actually, you know what? That's the last screen share I'll do here. If we go look at that 10-year bond yield, let's go look at 1987. It happened in the summer of 29, happened in the summer of 37, that long-term rates began to go higher in that year of these big kind of bear markets. And then, the equity market ignored it. You can see in 87, it really started happening that, that spring, and the market ignored it all year until it got out of control in September, October. So, you can see the yield on the 10-year went from basically 7% at the beginning of the year to, about 8 or 9% at the top of the market in August. But then that last move from 8 or 9% to over 10%, boom, that whacked the market. That became too much. So I would think that, you see when it take out the spring high here, if right now we take out, let's get a shorter term chart of the TNX. if we take out that high in yield from last fall, I think you can see here that's around 420. We hit it, and then that weak employment report kind of knocked us lower. But if we were to start taking out that low, and you can see when, or that high in yield, low in the bond price, you can see that's in 2022. That's when it started. When we took out the high yield of 2020, that's when that bear market started. So if we were to take out that high yield, say in the September, August, September period, I'd start getting really worried and really would get more defensive. Probably the market would start to roll over and then really accelerate to the downside in September, October, if that were to occur. So I just want to show you, this is my one thing. It's always been in the back of my mind. It's been in the back of my mind since I was a teenager. That's, because these governments are out of control. They spend too much money. The debts are too high. And at some point, we're going to get some kind of sovereign bond crisis. And the two things are that rate spike and there's some kind of default, or basically the governments have to respond with more QE in a period of already high inflation, and we get a super inflationary spiral. That the latter is probably more probable, but even before that inflationary spiral, you would probably get a period of a deleveraging. I don't like to call it deflation, because deflation to me is a longer term thing. Like, it's more deleveraging, just boom, a big whack in the markets. So I hope this helped you out. I wanted to show you why this worries me, has always worried me, but now in the shorter term, it's worrying me even more because of what's going on in the Japanese and US bond markets. Thank you very much. I know this one was a little longer than usual, but I think it's a really, really important subject.